Thank you very much. I'm not going to do my prophet of doom routine today, you'll be pleased to hear, so not too much contradictions. Like everyone who said before me, it is so nice to be here. I haven't done this in a while, so please be gentle. It is nice to be called a glamorous presenter, though, so I'm hoping that in the kind of post-pandemic world, this is at least going to be the new normal. So a few things, I am going to hit you with a lot of charts, so I'm going to apologise for that in advance in the next 20 minutes, but I will walk you through what I'm presenting. So kind of three key things that I want to talk about in the next 20 minutes or so. Where are we now in the economy? I mean, it's been a bumpy road, to say the least, over the last 18 months. So it's really just a kind of stock take of where we are at this moment. Particular focus on what we're seeing in the mortgage market. UK Finance collects a world of data from lenders, so we'll present some of our own data on that. And then just a few reflections on where we go from here and what the outlook is for 2022. I genuinely was trying to think of a presentation that I've given since the financial crisis where I haven't heavily caveated it with ranges of uncertainties, and this one is no different. I mean, there's a lot of upside and downside in the economy, so I'll touch on some of those just to finish. So let's start with the big economic indicator, what's been happening to GDP. So the chart on the left is the monthly profile of GDP in the economy, and then I've broken that down into the different contributions from households, business investment, net trade, and government. So I'll just talk a little bit about what's happened. I mean, we know that, the initial impact of the first lockdown was absolutely catastrophic on the economy, and you can see that from the very, very sharp contraction we saw from February last year. When the economy started to reopen, and we thought we were out of the woods last summer, and there was lots of kind of incentives to go out and eat out to help out, and shops and businesses were reopened, we saw that come back. But then subsequent lockdowns and restrictions on business activity, social distancing restrictions, kind of swung that into reverse in the second half of the year. Good news was, with Freedom Day, starting in April essentially, we did see quite a strong rebound in growth across the UK in the second quarter, so 5.5%. I mean, that was quite a bit stronger than people were anticipating, even if you look right at the start of the year. A little bit of plateauing since over the summer, July, August. Being part of that can be attributed to the kind of the pingdemic, where lots of people were being pinged by the app and kind of less able to go out and spend in retail and shops and restaurants, and it did actually have some impact on actually real business activity as well. But I think what you can see from the chart on the right, is that households have really been the key determinant of the path of growth over the last 18 months. So, consumers were basically prevented from going out and spending at the beginning of the pandemic, but they have been a key driver of that growth, particularly in the most recent quarter. And if we look at the kind of sectoral mix of that, a lot of that is contact-intensive services. If you go back to the beginning of April and look at what people were Googling for, one of the biggest areas of growth was pubs with beer gardens near me, and when does Primark open? Which kind of gives you a sense of kind of what is sitting behind some of these numbers. And actually, if you dig into some of the spending data that we've got at UK Finance on credit cards, it's all about going out, bars and restaurants, leisure activities, staycations. So that's really been a boost to growth more recently. That's going to tail off inevitably, so we're probably looking at more modest growth of around 1.5% this year. The Office of Budget Responsibility, the kind of government's independent forecaster, presented its forecasts alongside the budget last week. They expect growth to return to pre-pandemic levels around the turn of this year. So we're on the upswing for now. Focusing in on the labour market, because I guess that's sort of kind of relevant to the kind of communities that you're engaging with. I mean, if we go back to the start of the pandemic and look at what kind of forecasters were expecting in this unprecedented event of a pandemic, I mean, this is probably the area where we got it most wrong. I mean, we were expecting a very rapid rise in unemployment through 2020. You know, some talks of peaking unemployment rates at double-digit levels by the end of last year, and that didn't materialise. You know, we did see an increase in unemployment through the lockdowns last year, but the government's furlough scheme, the coronavirus job retention scheme, you know, made a huge difference to the labour market outcomes that we've seen over the last year or so. As the economy's reopened, we've seen unemployment drift down. Again, that has surprised to the upside. I don't think a lot of forecasters were expecting that degree of movement. And it's been fairly consistent across the country. A couple of outliers, Wales and Northern Ireland. But you know, it's essentially, we've seen a fairly consistent picture across the country. I think the big uncertainty is kind of where we go from here, and I'll kind of reflect on this at a couple of points in the presentation. Furlough is now ended, but we don't really know what's going to happen to those people who come off furlough. We know how many people were on furlough at the end of August, which was still about 1.6 million. So the numbers coming off furlough as the economy reopened wasn't actually as fast as people were expecting. And there was a bit of a difference between younger and older workers. I think that's probably the kind of key. A lot more younger workers were on furlough, but older workers have actually been slower to come off. We get numbers out tomorrow. The timing of this presentation is terrible. I would have had much more detail on what happened with furlough if we were presenting tomorrow. But I think that's kind of key in a lot of judgments about the economy as we move forward. I think the other kind of component around the labour market is what's been happening to wage growth. The official statistics are all over the place on this because you've had people on furlough. They disproportionately tend to be on lower incomes. So average income growth looks to be artificially inflated, essentially, at the moment. But underlying picture is fairly stable, around sort of 4%. A bit of acceleration is likely, and that is probably going to be confined to some sectors and occupations. So while what I've presented so far hopefully kind of chimes with what we've heard already, it's kind of fairly positive picture. We're on the up, labour market situation is good. It's not a pain-free recovery so far. You know, we do have some growing pains as we come back from lockdown and as the economy recovers. One of these has been kind of very widely reported in the press, and that's the issue of kind of capacity in the labour market and skill shortages. So we've got record numbers of vacancies, which should be fine, because if we had loads of people on furlough and we've got loads of vacancies, then, you know, we're all good, right? But there is the potential for quite a significant mismatch between the people who will be coming off furlough and these sectors that are particularly reporting problems recruiting. So it's not like you're going to get lots of people coming from the retail sector off furlough. Perhaps they don't have a full-time job to go back to, kind of wandering onto construction sites. So this is where you might start to see some kind of pressure in supply chains and some additional wage pressure. So that kind of mismatch is something that is preoccupying the Bank of England at the moment as well. I think the other sort of cautionary note I have about the number of vacancies, and this being a kind of clear sign that the economy is on the up, is that it's very easy to market a vacancy at the moment. So the extent to which these will all definitely translate into jobs, particularly when the kind of outlook still feels a little bit uncertain for some businesses, I think I've got some question marks. I'd like to see some kind of hard data that those vacancies are actually translating into more people on payrolls before I sort of relaxed about the outlook for the labour market. The other growing pain is this bit, two very boring charts, but the one on the left is essentially what's been happening to commodity prices and energy prices. The chart on the right is what's happening to inflation and the outlook for it. So again, lots and lots of media coverage about, you know, the fact that demand globally, not just in the UK, has rebounded faster than supply and production capacity, and that's everywhere. And it's not just kind of making stuff and getting it back into the market, it's also moving it about. And again, this isn't just about HGV drivers, which we've already talked about, and the shortage of those in the UK. It's kind of moving goods, you know, from Asia and having that kind of shipping and logistics capacity. You know, things aren't in the right place and there's not enough of it, and that's been pushing up commodity prices. Looking at kind of industrial inputs, they're starting to ease back now, but energy prices are still taking off. And that is the big upward pressure coming through on inflation, or at least one of them. I mean, there's kind of some mechanical effects to what's happening with inflation right now, because obviously during lockdown, prices were falling. There was lots of kind of government tinkering about with things like VAT and Eat Out to Help Out, which was bearing down on inflation this time last year. So there was an element of expectation that we would start to see inflation pick up towards the back end of this year on the back of those falls a year ago. But clearly, concerns about energy bills going up, the price cap, what happens next April when the price cap is likely to be lifted again, all of that is kind of pushing up on consumer prices, which is essentially eats into real disposable income of households. I mean, the good thing, I guess, from a consumer perspective, and this is some of our own data on the left, I do know my left and my right, honestly, is about what's happened to cash deposits and savings amongst households. So with limited opportunities to go out and spend, particularly on big ticket items, things like travel, which have essentially been off the agenda for the last 18 months, households have built up quite a bit of additional saving, and most of that is in instant access accounts because there's not a great deal of return on time deposits. So there's clearly a buffer there. It's not evenly spread across the economy. Obviously, people that have remained in work, people who own their own homes are in a stronger position than younger workers, who've potentially been furloughed. So there is a kind of uneven distribution of these savings, but clearly we know the savings rate has shot up over the last year or so. Flip side of that is what's been happening to inflation and uncertainty about the labour market has actually started to bear down on consumer confidence, which is the chart on the right. We can see that fell pretty hard at the start of the pandemic, recovered in line with reopening of the economy. But I think some of these pressures that we're starting to see, particularly coming through on household finances, are starting to bear down a little bit on confidence just now. And that includes things like, how individuals see their own personal financial situation over the next 12 months and an appetite to make major purchases. So I think that consumer confidence indicator is kind of one to watch to see if that can demonstrate any sort of resilience as we go into next year. Oh, I'm way behind. Right, okay, really quickly. I don't want to go down in a rabbit hole with this one. So this is the kind of policy backdrop for consumers. Bank of England decision tomorrow. Again, everything's happening tomorrow. It's already been mentioned. I mean, market expectations, so the curve on the left here is implied expectations of the market of the path of bank rate over the next couple of years, and they are expecting a move soon. Whether it comes tomorrow, I mean, I don't know. I don't have any more insight than anyone else in this room about what they're going to do tomorrow. Whether they should is another matter. It does feel evenly balanced. There's people on that committee who have never, ever voted for an interest rate rise in their kind of whole Bank of England career. But it's coming. It's just a question of when and how far and how fast it goes up. But even at 1.25%, which is where market expectations are sort of topping out in 2023, I mean, that's far away from the mortgage rates that we were looking at when we took out a mortgage, but not for a lot of people, who've been through university, bought a house, and have never seen interest rates at anything like 1%. So that's kind of, that kind of psychological impact is going to be kind of quite interesting. On the budget, I'm not going to talk about, because there's been loads of chat about budget measures. I'd say the key takeaway for me is that a lot of what was done was redistributive to lower income households, particularly things like universal credit. But I think the IFS analysis that if you're a median income, then your real wages and your real income is likely to be depressed and under pressure over the next couple of years, partly as a result of things like the NICS increase that is coming through and some of the other cost of living pressures that I've already mentioned. So that is the economy, which I've spent far too long talking about. So let's move on to the mortgage market. We've already talked about a little bit of this, so nothing contradictory at all. Another area where forecasters completely got it wrong was on what was going to happen to the housing market during lockdown. I sort of question why economists are asked to present anything about the outlook, given all we do is kind of justify why we were kind of massively out in the first place. But there was, as has already been talked about, kind of huge increase in purchase activity over last year and so far this year. Stamp duty holiday, clearly massive driver. That was really important in driving that growth, but it's not the only one. Remortgaging, that's held up remarkably well through lockdowns, kind of huge increase in product transfers. Prices have gone up, obviously, and they've gone up everywhere, but we're kind of, because interest rates are kind of record lows, few concerns about affordability. And then I'll just touch on the kind of payment deferrals, because obviously that has been an important element of kind of government and the industry working together to kind of mitigate the impact of the pandemic on households. So this is a kind of similar chart to one you've already seen. So this is annual growth in the number of new loans for house purchase since end of 2018. You can see the dip when essentially everything was shuttered back in March and no one was searching for new houses. But as soon as the market reopened again, kind of that rebound began. And essentially growth has hit record highs across a range of those first-time buyers, home movers, buy-to-let, kind of all surging and essentially at record highs in our data. I mean, we've talked about some of the drivers for this. Clearly, tax holiday, people kind of really wanted to take advantage of that. But there has been a huge reevaluation of people's individual requirements. Do they want space? Do they need an office? How long are they going to commute for? Where are good schools? All of those kind of questions, I think, households have been tussling with over the last 18 months. And obviously the level of savings that households have built up also enabled more of this transaction activity over the last year or so. I did say I'd talk about some regional stuff, but really there's not a lot of regional patterns to talk about. If we look at house purchase activity across the various regions and devolved nations of the UK, it's all one-way traffic. And it's not often that we see this in our data. London's a bit of an outlier, kind of clear strength there. And home movers have generally, that's where we've seen particular strength, because obviously there's been kind of more benefits from the stamp duty holiday compared to first-time buyers. But essentially this is an across-the-board growth in activity over the up to the first half of this year. Remortgaging, I said I'd touch on this, is a particularly ugly chart, but it does contain quite a lot of information. I think you're sending these out afterwards, so you don't need to absorb all of this now. But essentially, this is a breakdown of the types of remortgage activity that we see month on month. It's held up well, as I said, throughout the pandemic. Largely because, it's been driven by the schedule of maturing fixed-rate mortgages over the course of last year. Product transfers, the proportion of those is kind of strengthened, definitely, compared to where we were back in sort of 2018, 2019. Probably less need for face-to-face interaction, being able to do that remotely has supported that area of activity. What I would say is that we've seen a kind of growth in remortgaging where equity is being withdrawn. So again, we've kind of touched on some of the reasons behind that. People wanting to do home improvements, for example, build a conservatory, redo the office for working at home, but also gifted deposits and buy-to-let. And we see that being a driver of that equity withdrawal as well. Right, prices up everywhere as well. I've got my orange light on. I think I'm good. Prices up everywhere. So this is the average price. That's the bars, and the green blobs are the annual increase up to August this year. We've seen the strong demand patterns push prices up right across the UK in every region. My sense is and this is official statistics to August, if you look at more recent indicators from Nationwide or Halifax, for example, kind of feels like that's the peak, and we're looking at a bit of moderation. And again, if you look at the Office for Budget Responsibilities kind of forecasts in this area, I mean, they are expecting a kind of fairly smooth kind of glide path down, kind of stabilization of prices out to 2023. This is not where they were back in March. They were expecting falls in house prices, so there's been a kind of reassessment of the strength of the market. Prices should hold up, but we're probably not seeing a lot more opportunity for significant growth in that area. Essentially, some of these temporary factors that have been pushing prices up will fade over the next couple of years. Price growth has raised the bar for mortgage affordability, clearly. Loan-to-income multiples have risen steadily throughout the pandemic, which is the green bars. It's not my favourite chart, this one. But essentially, loan-to-income multiples, you can see there's a little spike up right at the end. But affordability of mortgage payments have actually remained they've been drifting down and have been stable. We've got a competitive mortgage market, rates are low. We've already talked about the percentage of people who are on fixed rate mortgages. Since 2019, 96% of new mortgages have been fixed rate, with about half of those on 5-year or more fixes. So this picture is likely to be sustained even with an increase in bank rate, certainly in the near term. Final slide. Oh, no, it's not. Penultimate slide. Surprised by this one. This is arrears. I mean, this was obviously an area of concern for an organisation like UK Finance. I mean, support through lockdown, I mean, it took many forms from government and the finance sector. Obviously, there was the furlough scheme, but also payment deferrals were on offer for mortgage holders. Around 2.5 million mortgage holders took out the opportunity to defer payments. And that accounts for around 1 in 5 mortgage holders. So that's quite significant support for the market in that respect. And it meant that arrears, which you might have expected to materialise in the absence of that support, actually didn't materialise and haven't done as yet. We've had a fairly steady picture. Clearly with the ending of some of these support schemes, we might see more repayment issues come through. But at the moment, and again, depending on how some of these labour market factors play out, it is all quiet at the moment. This is my final slide. Where do we go from here? So the recovery, as I said, is expected to continue. I mean, most forecasters are expecting a kind of decent recovery to continue through into 2022. I mean, my sort of concern here is it's not just about getting back to where we were. It's about getting back on the path that we were on before the pandemic hit. And the OBR forecast suggests that even at the beginning of 2025, our economy will still be about 2% smaller than it would otherwise have been. We saw this with the financial crisis. We didn't get back on our growth path after the financial crisis. We closed the gap, but we didn't kind of move the line out. And there is going to be an uneven recovery across regions. So the National Institute for Economic and Social Affairs provides some regional forecasts out to sort of long-range forecasts. Places like London, actually Northwest, by the end of 2023, 2024, we'll be back to where we were. Outlying regions, Northern Ireland, Wales, Yorkshire and Humber, lagging. So I think it's probably worth just recognising that there is going to be some regional disparity in the pace of growth and recovery across the economy. I mean, we've already talked about the end of the furlough scheme. I mean, that's the big one. That's the big one for decision makers. It's one that's going to be chewed over, I imagine, at the MPC meeting tomorrow. It is going to bear down potentially on demand, on growth, if unemployment does start to pick up. But we need to see what the profile of those furloughed workers and the ease with which they can transition back into the labour market takes. This final chart, if you've listened to nothing else that I've said in the last 20 minutes, because the light is now red, if you want to know what the British public are doing, look at what they're typing into search engines. And this is Google searches for mortgages. It's plateaued. I mean, it's still, I only go back to kind of the months before pre-pandemic. But you did actually see a bit of a spike as people were searching for this during lockdown because nothing else to do. But it's stabilized. So, I would encourage you, just keep an eye on Google Trends and see what people are actually looking for in your market and in your region. Doesn't suggest that things are going to fall off a cliff. But it doesn't suggest that we're kind of on the cusp of a kind of another big rebound in activity. And I shall leave it there. I hope that has given you some food for thought. I'm very happy to take any questions or challenge that you have to anything that I've said. Thank you.